Wasting much time, I would hand over to the moderator Asawaji. Asawaji, please take it.
Yeah, I welcome you all on behalf of Tax Friends Mumbai, Tax Practitioner Association Thane, Joe's Professional Foundation, Income Tax Association Varanasi, Income Tax Association Prayagraj, Legal Relief Society Kolkata, India Investor Club Mumbai, and Bhiwandi Tax Practitioner Association Bhiwandi. Uh, Before we start, a brief introduction of today's speaker, Mr. Nooresh Merani. Nooresh Merani is an IT engineer by qualification and a SEBI registered investment advisor, trainer, blogger. He has been analyzing and writing about Indian equity markets for the last 15 years at www.noorestech.co.in. His regular guest analysis on various business channels like CNBC, ET Now, etc., and very good friend of mine since more than a decade. In fact, I re-entered into market because of Nooresh Bhai. Nooresh Bhai, now screen is yours.
Yeah.
Yeah.
So just a minute, I'll be sharing a presentation with you on the. So give me a minute. I'll just share. Yeah. So I believe the presentation is in front of everyone.
Yes.
Yeah. So in today's topic, what I'll be covering is about what happens after a bear market. So we've had very big bear markets in 1992, 2000, 2008, 2020. When I say big bear markets, it implies a move of 30 to 60% on the index on the downside, and a lot of stocks falling 50 to 80%. And how opportunities come up in those periods, and we'll try to see it through the previous cycles and how it has worked. So we'll be taking a lot of data points, and this presentation, this whole data is already available on the website. So it should not be a problem if you miss out on something. So the first part of bear market is where the index falls by 30 to 60% and the broader markets fall by 40 to 70%. And every bear market fall is very different. But what we have noticed is consolidations are very similar. So the first few observations which have been very similar across various cycles has been that in the consolidation, the leading sector does not recover as fast. So for example, banks and financials were the leading sectors in the current move. From the 24th March low, the least recovery has been seen in the banks and financials. Same if you go back to the IT bull market or the real estate and infrastructure names of 2008 or the cement names of 1992. So all these sectoral stocks did not recover fast in the recovery. Also, secondly, the broader markets are not able to retrace very fast and go sideways with lower volumes. This is where the participation goes lower. And when we say lower, so for example, if a stock has fallen from 100 rupees to 30 rupees and the volumes are lower, implies earlier which used to take 1 lakh shares and now trades 50,000 shares, the volumes have considerably fallen down in terms of value. So that is where there's a total disinterest in equities. Then when this consolidation is over, how do we understand the trend has changed? It is confirmed by higher highs. So intermediate highs get taken out in the period of time. So that is when you start seeing a change in the trend. Also, what happens is post the consolidation, some of the laggard sectors of before or some new sectors or new set of stocks start showing strength and leadership changes. So this is how we'll try to look into the various cycles over the years and try to compare. So a trend change is confirmed whenever intermediate highs are crossed and trend line breakouts. So the consolidation could last months and years also. So what we'll try to do is we'll try to look at it through examples itself. So starting with the first fall. So this was the 1992-1993 consolidation. In the first fall from the peak of around 4,500 on Sensex, there was the first correction was 40-45%. And by the next two dips, it retraced almost 61% of the whole move. And the whole move was almost a 10x move from 400 in 1988 to almost 4,500 in 1992. So you lost out around 60% of the move. So there were two new bottoms after the first leg. So the first fall was 40-45%, and the retracement in the first place was 50%. So this is what I measure out with 1, 2, 3. Now this is what happened. This is what we call the consolidation. After the first fall, there were two other new legs wherein we made two new lows, then consolidated, and somewhere in 1993 we had a classical falling wedge breakdown or a triangle breakout, which signals a trend change. So this took almost 50 weeks, so almost a year, after which the recovery came and we were back to the new highs in a year or so. So that is the kind of recoveries also which happen, which is very, very swift and fast. So that was the first part, the fall, which was 40-45%. The second part which we'll look at is the consolidation. The third is the trend change. So when the trend line change happened, breakout happened in 1993, in the next 1 year, the Sensex reclaimed previous highs. Stock specific behavior, generally 50% of the stocks do not make new lows in the consolidation. So what we see is in the second two bottoms, many of the stocks do not make new lows because in the first fall itself, they would have corrected a lot. Then we look at the 2000-2003 consolidation. The first fall of IT and telecom led bull market was almost directly equivalent to 60.8% of the move. But post a recovery, this made three new lows and did a full retracement. Now, what is interesting to note in this period is this bull market was a very, what do you call, concentrated bull market, wherein it was only the IT and telecom stocks which really did well. And most of the old economy names, most of the other names did not do well. So we did end up making a small new high on the Sensex, but it was not a big move. And by that time, weightage of telecom and IT stock was really high in the index, and subsequent correction, a lot of these names fell by 80-90%, leading to a deeper fall in the broader markets as well as the index. Then we can see a classical wedge first, which is a falling wedge recovery on a breakout in 2001. Then it goes into a proper consolidation, which lasted another 87 weeks or almost closer to 1.5 to 2 years. And then came the big breakout in the middle of 2003. And in that, after the breakout in next few months itself, he reclaimed those highs. Now, why do we look at this period is because this is very similar to the current period which we have. We had a rally in 2018 to 20 the indices, where Nifty went up really well over a period of time, but the broader markets did not do well. So we've been in a bear market for everything apart from Nifty from 2018, but Nifty has been in a bull market since then. Now, the trend change was clearly shown by a major breakout in 2003, and the new highs came in 6 to 8 months. Now, stock behavior. In this period, 58% of the stocks fell more than 50% in the 2001 fall. Now, this could be higher as a lot of companies went bust. The data which we use has survivorship bias, and we take only NSE stocks. So you can say 60 to 70% of the stocks fell by more than 50% in that fall. 47% of the stocks fell by more than 60%. And only 10% had a positive return in that period in the fall. Now, this is the interesting data which tells us what happens in a consolidation. So February 2000, which was the top, to 2001, Sensex was down from 6150 to 2600. So out here, if you notice, majority of the stocks have fallen by more than 50%, which is which was closer to 58%. But the next part is very interesting. The recoveries from 2001 to April 2003. In this period, 2600 was the bottom of Sensex in October 2001. And in the next dip after the recovery, Sensex was at 2900. So the Nifty and Sensex was only 10-12% from the previous lows. But in that period of 2001 to 2003, almost 141 stocks or 25% of the NSE stocks had doubled from the lows in those 2 years. And almost 45% of the stocks had more than a 50% return in those 2 years. Now, that is almost 250 stocks. So what it tells you is that consolidation, there are a lot of opportunities because there is a lot of trend change, a lot of new stocks come up, a lot of large start doing well, which is the case which we are seeing right now in 2020. A lot of stocks have started going up 50% from the bottoms. And even when we see another dip going forward, they may still be higher from the lows in March 2020. Now, by end of the consolidation, from the top of February 2000 to April 2003, what we see is now only 43% of the stock are down 50% from the top. But in that period, almost 29% of the stocks had a positive return and had crossed the highs of February 2000. So this is very interesting. You peaked out in 2000. In 2003, the index is still down almost 50% from the highs, but almost 30% of the stocks have a positive return period, which I mean to say is you've actually crossed an equivalent of 6,000 Sensex, whereas the Sensex continues to remain at 3,000. So this is where a very huge surprising change in the consolidation is that even though the markets, the broader major benchmark index has been sideways down 50%, there are a lot of stocks which have become positive in that period and have recovered really well from the lows. Now, let us look at the sectoral change which happened in 2000, 2003. So I'll quickly take you through some indices. So the last one is the IT sector, which was almost down 90%. The whole sector was down 90%. But the other old names, which are the FMCG stocks, the old economy stocks, the old oil and gas stocks, which were not the participants of the 1998 to 2000 rally, how they recovered really well. So BSE auto index fell by 67% with the markets, wherein the index fell by 60%. But in the period of 2001 to 2002 itself, it went up 115% from the lows. And when the Sensex again went to 2900, made almost the same lows, this index was up 75% from the lows of 2001. By 2004, it was up 5x from the lows of 2001. And it was 60% higher than the highs of February 2000, wherein by 2004, you barely reached the same prices of the Sensex. And by 2007, it was a very different story altogether. So this is what implies is in that period, everyone disregards a lot of companies. So auto sector was not the favorite. It was all about IT and telecom. People wanted to average. But this sector in those 3 years was up 5x from the lows. And from that bottom, in that consolidation, it was up from 75% to 100%. Next was capital goods. Again, similar, fell 60%, just like the index. Recovered 100% from the lows. By 2002, 2003 bottom, it was up almost 60-70%, 80 to 90% by 2003 bottom. It was up 5x from the 2001 lows by 2004. And this index went up to 21,000 by 2007. So it went from 500 to 21,000. It was up 40x from the lows of 2001 and 20x from those of 2003. So which is unimaginable. And this is the type of trends which happened after the bottoms. So who would have thought in 2001 a lot of capital goods companies which were quoting at single digit multiples will end up becoming 40 to 100x. The same thing happened with BSE metals index. 55-60% in the first fall. Recovered 120% in the recovery in 2001 to 2. Up 80% even by the 2003 bottom, while the Sensex was only up 12%. It was up 7x by 2004. It was up 20x from 2001 lows and 10 to 12x from 2003 lows. So the point here is the index made a bottom in 2001, but most of the sectoral indices, the index made a bottom in 2001, almost retested it in 2003. But quite a lot of sectors had already bottomed out and started at a trend from 2001 itself. Same with the PSU index. So the index fell relatively lower. It fell 50-55%. Recovered from 733, recovered more than almost double from the lows by 2002. It was up 130% from the lows. And by the time you made a double dip in 2003, it was up 100% from the lows of 2000. This index went up 6x from the lows of 2001. So PSU was one of the most surprising moves of 2001 to 3 and 2003 to 7, which was one of the biggest surprise and did really well over the next few years. So this is what happens in the leading sector. So the IT index in the first fall fell by 60-70%, but it did not recover and made new lows in 2001, 2003. And even after the full recovery, even by 2007 and even up till 2017, it was not able to go back to the same highs. Even though there was earnings growth in a stock like Wipro, the highs of 2001 were never reached again. Some stocks like Infosys did well. HCL Tech did well. So this is what happens after this. The other indices also, that the index like oil and gas was up 70-100% in 2001 to in 2001 to 3. The another interesting scenario in this period was that FMCG in 2003, which was a defensive move in that period. So in 2000 to 2003, it topped out, and it was a laggard for the next 10 to 12 years. At the peak in 2002 to 2003, Hindustan Unilever was almost 12% to 10% of the Nifty and Sensex. So it was the largest weight in the index and did nothing for the next 10-12 years. Even pharma stocks did not recover in 2001 to 2003. They recovered only in 2004 onwards. Now we look at the consolidation of 2008. This fall was huge. The total retracement was almost 75%. But you also have to note that it was up 7x from the lows of 2003. The first fall was of 30% in January 2008, and the final bottom happened in October 2008. So essentially, what we notice in 1992, 2000, 2008, you almost end up losing 60-70% of the move from the top. The consolidation in 2008 lasted a really small time. It lasted for 5 to 6 months, from October to March 2009. The stock behavior, it was brutal. When I say brutal, 87% of the stocks were down more than 50%. 79% of the stocks were down more than 60%, and 60% of the stocks were down more than 70%. So it did not matter, and hardly any, there were just 4 stocks which had a positive return out of 900 plus stocks. So because the rally was huge in 2003 to 2007, the fall was also as brutal in the same way. Now, what we noticed between that 5 to 6 month consolidation period, 30% of the stocks did not make new lows. 20% of the stocks had 25% in that period. 70% of the stocks were higher by the second dip. So 30% of the stock made new lows. 30% of the stocks were roughly higher than 25%. But 70% of the stocks, which actually tells you is in this next dip, 70% of the stocks did not make a new low. This was the case in 2001 to 2003. Almost 70% of the stocks did not make a new low in the second dip. So this is what we assume from this fact, that if we are making a low in this period in March 2020 or in this 2020 period, and this continues for maybe 1 year, 1.5, 2 years, whatever be the correction, what would be interesting to notice in the next dip, most of the stocks may not make new lows on the broader market. Now, the sector change, real estate infra got whacked by 70 to 90%, and they've still not been able to recover. Capital goods, which was again the torchbearer of the 2003, you can still see a lot of stocks have not recovered even after 12-15 years. But a new sectoral change happened. FMCG stocks, which did nothing between 2004 to 2007, did really well. Pharma came up, consumer names came up, home building materials. Then a few years later, it has been chemicals and financials took the lead. The next decade, all the performance of 2003 to 7, 2001 to 7, like PSUs, for example, have been whacked for the last 12, 15 years. So that is a big change which happens after the market, which is where one has to keep an open mind. Now let us look at the fall of 2020. Now in percentage terms, the fall is 40%. But what you notice is it has retraced 50% of the move from 2008. And say consider from 2010, 11, or say 2013 onwards. We've retraced 67% of the moves from the various levels. So the problem is a lot of us want the next dip to be really, say, deeper. But what we say is because the bull market was not very strong like the previous one, in the first fall itself, we've retraced 60-70% of the previous move. So we've gone back 5 years, like which happens in a bear market. So there's a good chance we may not have a big dip in the next one, and maybe we've already bottomed out in March 2020. So the retracement has been large, just like previous bear market, but it's not a 60% absolute fall. So in previous bull markets, 1992, 2000, 2008, the absolute fall was 50%, 60% from the tops. Right now, the fall is only 40%, but the retracement is almost similar to the previous bear market. And for that reason, most bearish expectations are placed between 6400 to 8500, where 6400 is the peak of 2008. What we generally see is in 2008, we made a bottom at 8,000 Sensex. The peak of 2001 to 2003 was 6,200 on the Sensex. So we are almost seeing a similar, say, structure, whereas Sensex instead of Nifty in terms of price points. So we will expect 6,400 to come back again, because even in 2008, we did retrace back to the previous breakout points. So the current behavior is very close to the falls of 1992, 2000, 2008. This suggests we are getting into a consolidation when we have just one more down leg, which might have started from 9,900. So this is what we are expecting. Now we are back about 10,000. So maybe it will start from 10,500. The next leg is where it will become interesting. Now look at the damage in 2020. 79% of the stocks are down more than 50%. 70% of the stocks are down more than 60%. 56% of the stocks down more than 70%. Now compare this with 2008. This number was 87, 76, and 60. So if you get the last one, 56% of the stocks down more than 70% is equivalent to a 60% of the stocks down more than 70% of 2008. So it's brutal. So it's been a very difficult bear market than 2008, because there was not a great bull market like 2003 to 2007. So it is a bear market without the bull market, actually, in that sense, in terms of comparison. So that's why it's very, very interesting. So the sectoral changes. So going forward, what do we need to see? So now going forward, our assumption is either the laggards or new sectors come in. So for example, let us look at the history. IT and telecom was a new sector in late 1990s. Old economy stocks for laggards in the 1990s did really well in 2003, 2007. Real estate and infra were new sectors. A lot of new listings came in. To pharma and FMCG were laggards of 2002 to 2010. Chemicals were laggards for 20 years. Agrochemicals is a new sector which was really well in 2014. Now, there were more NBFC names which got delisted in the 1990s and who got busted than the number of NBFCs listed today. So it was a terrible sector in the 1990s, but did really well from 2014, 12 to, or even 2010 to 20. Some of them were brokers before. So what we see is a new sector will start leading the case, or some of the old laggards. And this is where you have to start looking at our price action, and relative strength starts coming in when a sector does not fall as much with the index and tends to make new highs. So going forward, there will be new sectors and also transformations where the companies have maybe transformed. For example, where was an IT company to start with? So we'll see a lot of sectors transform, maybe next generations come in. So one has to keep a very open mind to what could be the next leader, because chemicals were said to be commodities and bulk chemicals. Today they are called specialty chemicals. companies which used to never get 6x of P are getting 6x of sales. A provider to this sector is getting 10x sales. So that is the kind of change which happens in terms of valuations. So you go from 6x P to 6x sales, now 6x P to 25x P. So we need to keep an open mind going forward, because there could be very different changes in terms of sectors, in terms of stocks, in terms of what sort of stocks will do well. We compare the current bear markets to previous bear markets, as equity markets go through cycles. So cycles are similar, but reasons are very, very different. So 1992 reason was different, 2000 was different, 2008 was different, 2020 is different. But what we've seen is over a long period of time, things do change. Also, a lot of bear markets coincide with bad events also. So this is where it aggravates the underlying conditions much more. So the 2001 terrorist attack, the global financial crisis of 2008, the bull market was already doing well. The COVID in 2020. What we've noticed is a lot of change happened in the short term, some in the medium term, and in long term we get back to human nature. So after 2001, a lot of security systems changed. So up till a couple of years, even in the airports and on the domestic airports in India, you were not supposed to remove your belt and shoes. Now you are supposed to do that. So the changes have continued for the last 20 years. After 2008, everyone was debt averse. So people used to love EMIs and debt. We actually have a movie called EMI. So in that period, everyone thought we'll never take debt. And by 2020, you're taking debt for even travel. You're taking debt for phones. You're taking debt for everything. So what we've seen is a lot of change in the short term, but in the long term, we get back to the human nature of consuming more. So lockdown has shown us how little we need to live, but is that the life we want? Is this the way we want to live? And over a long period of time, we go back into the same. Then the Nifty might have started a bear market in 2020, but the broader market has been a bear market from 2018 to 20. Like 2000, 2003, the index took a long time to bottom out, but a lot of sectors did huge moves. So there could be a lot of similarities in the current period. So there are two types of there are two distinctions nowadays. A lot of large cap quality, large cap, mid caps. Strong businesses are priced to perfection. So when I say a lot of FMCG, a lot of paints, a lot of chemicals, a lot of pharma companies, some of the pharma companies, not some consumer, are priced to perfection. When I say price to perfection, they're quoting at 6x to 12x sales, quoting at 50 to 80 times P, and the growth will not be commensurate. Also, there's a lot of herding. So mid cap, a lot of chemical names in the mid cap have MFs owning 15 to 20% of equity, but FIs only own 5 to 10%. So this is one of the rare times where a sector has been bumped up only by domestic participation. Then there is another section of the whole universe. Earlier, we used to look at replacement cost. Now we see a lot of small caps and micro caps and mid caps below liquidation value. So even the exchange which we trade on BSE trades below cash. So this is where a lot of opportunities will come up. The FII holding in the BSE fund is back to the lows of December 2013. And in overall market cap, they're down to 18-90%. Previously, the low was 16% in 2008. What we've seen is there has been a huge change in terms of participation. A lot of money has started coming through mutual funds and say indirectly through insurance and to EPFO. So a very simple number is the Indian investor stimulus to the equities is equivalent to the stimulus given by the government. So the government has given a fiscal stimulus, which is, say, in actual terms around 2 lakh crores. The annual stimulus by Indian equity investors is closer to 2 lakh crores. That is 1 lakh crore coming from SIP, 60-70,000 crores coming from EPFO, and 30,000 crores coming from 60-70,000 crores from LIC and 30,000 crores coming from EPFO. And I'm not even talking about direct equities or say other insurance companies. So that is the kind of flow is there, and which is leading to a lot of polarization in the large caps. But when the economy turns over the next few years, you'll see this polarization change and a lot of huge opportunities come up in the broader markets. This is purely due to mispricing. There could be times where a company will do well because some other company in that sector has gone bankrupt. So a lot of, say, bull markets start for various reasons. So we don't know what could be the reasons. So you have to keep researching ideas, keep researching sectors. So some examples is of how laggards come in. Cements or laggards from 1992 for the next 10 years did well in 2003 to 7. PSU metals, capital goods, etc. went up 20 to 100x in 2003 to 7. Pharma and FMCG was supposed to be defensive, went up 10x in 2010 to 2015. Even when Nifty was not doing well. Chemicals are done well. NBFCs are done well. So some way to look at it is why do we need to keep researching a lot of stock ideas and sectors today is because there will be severe mispricing because of the current situation. So there can be cash bargains. There will be cash bargain because of a fire sale by institutions because they don't want to be in micro caps. They don't want to be in small caps. The mandate does not allow. Some HNI has to sell shares because he is leveraged. There will be a lot of mispricing because of mispricing in the balance sheet of the investor and not in the balance sheet of the company. In particular cases, you'll see insider buying. Now, for the first time, we have started seeing open market buybacks. We've always very rarely seen open market buybacks. We generally see tender, wherein the promoter also tenders. We've started seeing open market buybacks, which used to happen in 2008 to 2011. We've started seeing delisting offers again. So, for example, today itself, Hexaware has announced delisting. You are seeing Vedanta wanting to delist. So these are the times where the promoters are telling us the cycle is at the bottom or closer to the bottom. So why do I say is a lot of things change? So I remember buying Garwale Volvos because of one of my mentors explaining me. The stock used to quote at 4p and 6% yield. And one of my companies which did it really well, Aarti Industries, used to quote at 6p, is now quoting at maybe almost 3x, 4x sales. So earlier the reason was to buy them cheap. But in 2014, the whole transformation in companies was like this became growth, quality, sector tailwind. So the reasons itself changed. So earlier, which was a bargain, became a growth company. So there could be changes. So you have to continually keep changing it. So there could be new stocks, new listings also, which could take leadership. So every bull market, one makes mistakes. So I've made plenty. I'm down 50% from the peak, relatively better after the pullback. This has been one of the highest drawdowns since 2013. So, but the fact is your portfolios will be down. If your portfolios are not down this period, then they will not be up same way in 2021, 22, whenever the rally happens. Because either you cannot have the best, say, up and lower order. But the fact is a bear market hurts you in various ways apart from equity. So it will hurt you in various ways like your business. So for example, today being in Mumbai, I don't know what I worry about more, whether the portfolio, whether my business, or whether COVID-19 catching me. So going forward, there could be a lot of job losses and business losses too. So the interesting link for somebody if you have lost a job. But what we see is there could be a lot of after effects of a bear market. Because when a stock, say a lot of stocks are down 70%, eventually happens those businesses are also down at least in a similar way. So a lot of businesses will hit not just because of the mistake, but because of COVID. It could just be because somebody else screwed up. So for example, a friend lost a job because promoter had to shut down his profit company because there were no funds to run it because he got a hit in another part of his business. Same way you may get a hit because you have receivables from one company and that company goes bankrupt. Now tourism, aviation, hospitality, oil, they've gone berserk in terms of getting hit because of COVID-19. So there will be hits coming from you from unexpected places. But what we know is when we look at into history, nothing lasts forever. So I'll quickly now sum it up in terms of what I saw is I've not seen a lot of cycles personally from the markets. I've been in the markets only from 2004. But I'll tell you what I saw personally from 2000 to 2007, which was a cycle change. So in 2000, I used to do promotions for a .com company, a few .com companies, wherein we had to actually distribute goodies by just taking email IDs. So you get paid for noting down email IDs and give goodies, which would end up with us because we ended up giving the maximum email IDs. I remember actually noting down rickshaw numbers also in that period as a promotion because some .com wanted to start up on that area. Then I went through marketing surveys for brands which were coming in India. So I actually did marketing surveys where you had a group discussion for an hour or two. Say Pepe jeans coming to India. So what does a 18-year-old want in a Pepe jeans? So that was the period. And when I got into engineering in 2002, by that time the cycle was so bad. The placements were very low in our college, and we had our last year final year graduates who passed off last year becoming professors in our college because a 10,000 rupee salary in the college was better than what a lot of engineering companies were giving in, and also they had not got any placements. And secondly, a few of them wanted to go up. So that was the time when there were no jobs. And cut to 2005, when I got into, we were in our third year of engineering and we had just completed 6 semesters and 5 semester results. We had placement. I had 2 jobs by the time I had passed 5 semesters of engineering. Now cut to 2007, when I got into full-time equities, we had a solid run. So I remember I did not have time to go for IPL matches because the bull markets were crazy. Cut to 2008, I had too much time to play cricket for 6 months. I ended up enrolling for safety because I had a lot of time. This is the way cycle turns. In 2011 to 13, we saw a lot of job losses in the financial industry. In 2008 to 9, some of my friends who did MBA just after engineering had a tough time getting a job. Some of my juniors in engineering got a job, but placements were delayed. Some placements got cancelled. So a lot of timing has nothing to do with what we've done, but because cycle came. 2011 to 13 was a tough time for financial sector. 2013 to 17 has been superb for new finance. So 2018 to 20 has been tough for investors like those into markets full time. But going forward, what will change? We don't know. So just quickly summing it up, today everything looks bad, but maybe a couple of years down the line, there could be new ways where things go beyond. So that is how I sum up. And so the view is keep researching for new ideas, keep researching micro caps and small caps. Avoid large caps like a pole because some of them are really, really expensive. So this is the time where you keep researching and there could be some amazing opportunities. Any other details, you can always get in touch with me on the mobile number or the email ID. And I'm very active on Twitter, as well as this whole article is posted on the website. So a lot of data points are there. If you have any queries, we can do that. So if you have any questions, we can take now.
Savaji, please.
Yeah. Thank you, Nooresh bhai, for crisp and well said summary of various bear market and then consolidation and then emerging of new sector. One question from participant is, what could be new low on Nifty level you are perceiving?
So my view is we may not we may not sustain below the lows of 7,500. So
Okay.
it can get tested, but what we is because we look at Nifty. So one of the largest weights in the Nifty is Reliance. I find tough will see new lows. So if that 10-12% of the index does not make new lows, how will the index make new lows? Because banks and financials have already fallen and they're still down 50%. So it is going to be tough for it to be retested, or if it's retested, it may not sustain. For now, the view is we may not test it. Even if we test it, most of the stocks may not go back to the same prices.
Okay. And one of the view, Nooresh bhai, you told us that something new sector emerges. So, what could be the new sector? You are saying this could be a new sector emerging from this bear market.
So the view is that the new sector is generally after the bull market has been established. So, for example, in 2003 to 7, real estate and infra stocks were the new sector. And a lot of those companies actually got listed in 2004, 2005. So, there is a good possibility we will come to know about the new sectors in the next 6 to 12 months. So, as of today, I'm only focusing on laggards.
Okay.
Because laggards are where, for example, last 5 years, pharma was bad, has now started showing leadership.
Okay.
Power stocks have survived for the last 12, 13 years, are now starting to turn around. So looking at laggards more today than new sectors, because new sectors may be a bit later.
Okay. And what would be your technical view on ITC and Reliance?
So ITC is a very nice example about what happens because of sector rotation. So this stock was a, say, dog of the Nifty for the last many years. At one point of time in 2012, it was largest weight on the index. So it used to be 10% of the Nifty. And since then it has been bad. And even going into the COVID crisis, the stock was correcting. But now that you have to see the money is moving from banks and financial, which is the worst affected. So ITC is back to 200, which was the price in March. And even though ITC is affected by the COVID crisis, like many other companies. So what I see is ITC at 150 is super interesting because 150 to 170, because it still makes a cash guzzling machine, as in a cash payout machine. So the dividend yields will be great. And we believe 150 a major bottom has been made. So maybe I buyer at dips and maybe a stop loss below 140. So I think ITC is interesting, but on dips.
Okay. And Reliance?
Disclosure, do your own research. So
Yeah. Though he is SEBI-registered investment advisor, but you are putting your own money, so be careful. Be do
yes.
your due diligence. He is sharing his views. There is probably he may not be invested in ITC and all. Since I know him, I know he will be not investing into this kind of stock. Nooresh bhai, any view on Reliance?
So
Lot
again,
of
Reliance is
negative and positive views are coming. Some people are super bullish, some people are super bearish.
so my view is Bhav Bhagwan Che in such cases when you are confused. So the Bhav does not tell that there is anything negative as of now. So maybe for now it is extremely positive. The charts are positive. The price is positive. Relative strength to the index. So for now you'll go with the fact that the price is great. So I think the strength is. So it takes 20% from current prices. We may review the stance, but as of now it is positive. And
Nooresh
it
bhai,
has been
you
a sector for long.
okay?
It's been a laggard for long. It has started only moving the last 2 years. It was laggard for 10
Yes,
years before that.
yes. And one thing you told us during your presentation that some of the stocks are available even at lesser than liquidation value. Probably those stocks which you are saying laggards. So if you can name, if disclosure norms doesn't apply to you, if you can name few of the laggards which can be looked into.
So one sector which I like is broking, asset management, exchanges. So broking companies, because they have been in a 15-year down cycle, and it's a big consolidation, I think, because no new broker has come up in the last 5 years. So the last new breakers came only in the discount broking segment, which was Zerodha and others. So no new brokers have come up. No new exchange can come up. So, and the pricing has continued to be lower, and everyone hates the sector. But for example, Bombay Stock Exchange Limited itself is below the cash available on books, and then maybe you can add up the value of the it owns. So, and it has shares in CDSL. So it will be a high dividend payout. So it could be interesting. Then maybe there are small broking companies like MK Global, which is below cash. So maybe the market cap is 90 crores and the cash in the books is 130 crores. Then there is IFL Securities, which has a lot of say, real estate also. Then Motilal Oswal and ICICI Securities are super brands. Then Nippon Asset Management India. So this is a basket which you have to look at. So anything related, because going for CDSL, for example, because I believe in the next leg of the move, whenever it comes in the next 2 to 4 years, we'll see direct equity participation come back, which has not come back after 2008. So I guess this is a sector to look out for. And there are many micro cap companies where you'll see cash is equal to market cap. And many cases, you may actually look at the gross block deployed over the last 10 years to be, say, 500 crores and the enterprise value at 200, 300 crores. So you may end up saying, yaar, iske machine ka bhav itna hoga. Forget the land or the business itself. So if you think a lot of companies can survive, you can just go through, and you guys are the best in terms of balance sheet. So I see a lot of companies at liquidation value. So if business can survive, there are multi-baggers.
Okay. And any view on two sector I am talking about? One is PSU basket, and second one is infra.
So in PSU basket, I'll differentiate into two baskets. One which are terrible businesses in terms of leverage, in terms of etc. So banking, for example, in PSU banking will be a tough one. Then there are lending institutions which are tough, but then there are solid businesses also like RITES, Aircon, even say mining companies like NMDC. Now these are decent enough businesses. There are new companies like Midhani, which is very, so there are this type of businesses, and then there are tough lending institutions. So the rest of the businesses are very interesting, but what we see is we still do not see say from the government for the shareholder. So the day we see one disinvestment going through, that is the time I'll be excited about PSUs. But till then, I watch the space. Everything is cheap in the PSU basket, but the promoter does not want it to be expensive. So till that time, the re-rating may not happen. But it's an interesting space continuously on radar because valuations are cheap, liquidation value pairs, etc. But in other private business, the promoters want to run the business and want to make it expensive. PSUs mein abhi tak we don't see that. But very interesting space. Infrastructure, there are not many companies actually listed. So the largest one is L&T, which nobody can understand. But other names are not very great, but so we'll have to watch out.
Okay. And one of the theme which generally my kind of people follows, we try to see whether is there any possibility of mid cap becoming large cap or becoming say large mid cap. So you seeing any stock which potential to become say from small migration of see his structure from small cap to mid cap or mid cap to large cap?
So my view is today I'm not trying to make conclusions. So I'm only researching. So problem here is that currently, if we could see a lot of promoters do not know कि business क्या होगा आगे. So how do we know the small cap will become? As of today, you take a valuation call. So this is like 2013. आपने घरवारे वॉल्लोप ले लिया क्योंकि वो 4P है, and it is below acquisition. For example, Atul at one point of time, one of my mentor investors said, oh, I think it was 60 rupees or 100 rupees. He said, इसके machine का value market cap से double है. Business तो कितना होगा? So has been a 50 bagger since then. But at that time, Atul Limited.
Atul Limited. Okay.
Right. So at that time, you did not know Atul will go from a good chemical company to a specialty chemical company, which is now lauded by everyone. So viewers today buy valuations, buy decent companies, and then follow कि कहाँ पे earnings कुछ change हो रहा है, चीजें. Because today, if you make a conclusion, this is the great sector and something changes, then you will be stuck with it. So open-mindedness is the key today.
Nooresh bhai, one of the personal question, you being a leading technical analyst, probably last 1 month, how you seeing too many calls you are getting from your client or friends like me?
So this has been the most interesting times in terms of a bear market. So when we look at, there is a lot of, say, there are inquiries in a bear market in terms of advisory services, in terms of training, in terms of various parts. Earlier in bear markets, used to not get this. Secondly, if you look at the data, Zerodha, for example, saw the largest client acquisition in April. IIFL Securities saw the largest client acquisition in March quarter. Even in the US, Robinhood has seen the largest client acquisitions. So what we are seeing is, I don't know whether it is good or bad. So it is generally bad that new investors come in because they are generally at the end of it. But this is the first time we are seeing new investors come in the bear. So maybe it will not be an easy ride, but these are weird data points. So ideally, we generally see new investors come in the peak of the bull market.
Yeah.
You don't see investors coming in the bull market. So new accounts are getting open, broking accounts. So what we are seeing is maybe there's a shift from mutual funds to direct equity participation. So there is something Warren Buffett says accumulation is better. So pandemic. So I don't know. So whatever Warren Buffett says and what he does is very different. So I think we should not look at that. We should make our own. So for example, the joke today in the US is Warren Buffett is selling Delta Airlines, and all Robin Hooders have been buying Delta Airlines. So let us see who wins over the next few years. And Warren Buffett has made losses. So we don't know what, we don't need to see what other investors say, but we may have a very different. So we can learn from them. But what is going to happen in the pandemic? Nobody has seen a pandemic before. So I think it's a new world. We should not read what others are saying. Try to make your own call.
Yeah. Even one of the view is that see, this is time not to see profit and loss account of the company. It is better to see balance sheet of the company, and looking at balance sheet, if you can think about that this company will survive pandemic because of say sufficient cash balance, not too much debt, then probably that kind of company you should invest. This is my personal view, and which is we have discussed along with earlier. We had a discussion with Nooresh Bhai and couple of other friends, and that was the outcome that you should, at this pandemic situation, everybody will get hit. Maybe somebody 10% or somebody 90%. That's a different issue. But you have to see how their balance sheet is. If balance sheet, quality balance sheet is available, then any company can become multi-bagger. They can survive this pandemic.
So one more observation.
Yeah.
So one more observation is you also have to see the balance sheet, because somebody goes bankrupt. Because of that, the other company in the sector will do good. Very sad way to look at it, but this can also happen.
Can you repeat again, Nooresh Bhai?
So you also have to look at bank balance sheets, because one company goes bankrupt, some other company in the sector does well because they get it for free.
विजय
जी आई फॉरवर्डेड यू सर, कुछ मैंने व्हाट्सएप पे यूट्यूब पे क्वेरीज फॉरवर्ड किए, जरा देखिए।
एक मिनट
यूट्यूब के जो क्वेरीज आए वो मैंने आपको व्हाट्सएप पे भेजे।
See, Nooresh Bhai, there are a couple of questions in our YouTube channel. One is, can you provide some good script for long-time investment, with a long-term investment?
See, the problem is today, I don't know what will change after a year or so. That's the reason I'm not recommending stocks. So maybe one sector which I've said I like broking because they're cheap. So I may not lose if I go wrong. But in most other cases, I don't know how much will I lose if I go wrong. So I would say one sector is broking basket, and rest, do not look at long term. Look at valuations today and see what is changing after 6 months, 12 months, 1 year, 1.5 years, 2 years. Because a lot of companies which are cheap today will, at 50 it is good, but at 200 it is great because business changed. So we have to revisit our thesis to buy cheap today or buy something you like, and then keep doing. Maybe new sector will come up which we don't know about. So keep open-mindedness. So nothing is long-term, nothing is short-term. You're open to everything. So there is one question on Zoom: will option strategies be good? So this is one thing which I'm reading up on personally, because option margins have been reduced. So there are good ways we'll be able to hedge our positions, also hedge your portfolio also, as well as we make some income on portfolio. So because margins are down for a lot of hedge strategies, so you have to be open. For example, we should not do that many option strategies, but we may do in the next 1 year.
Like Nooresh Bhai, you told about your liking on broking company. Do you see consolidation in that sector or any other sector?
I did not get the question.
See, you have liked the broking segment of the listed space, those companies who are into broking. Are you seeing any kind of consolidation in broking space?
So there is a huge consolidation. If you look at the data for the last 5-8 years, number of soap brokers have been going down. New brokers are not taking up the case. So what we see is, and today there is a big trust deficit because of a few broker defaults. So today, if I want to open an account, I like to open it with somebody who will survive. I don't want to take the risk with any broker who has a bad past or I don't know his name. So a new investor also will go with broker who he has heard the name. So that is a trust deficit plus consolidation.
And one of the question in YouTube is that whether you are seeing new lows coming, maybe the third low coming in near future.
So my view is, even if the Nifty goes back to the same bonds, a lot of stocks may go back. And we should stop looking at Nifty because Nifty is like top 20 stocks are 80% of the index. So like 10% of the index Reliance. So the problem is you're trying to make a view on what you will do, what 10 people are doing. So we should not look at Nifty, you should look at stocks and sectors very differently. So my view is we may not go back to the same lows in many of the stocks which have been bought in March 20 unless there is a huge change in COVID in terms of something very different happens like COVID again. So in the current scenario, what I see is liquidation cost remains the same even across a year also. So my view is may test the lows or maybe even higher bottom, but a lot of stocks may not.
Vijay, this is end from my side. If you have any other question, you can raise. Otherwise, let me proceed for vote of thanks to our speaker and all participants. Vijay, am I audible?
Yeah, there is one question on the future of chemical industry.
So chemicals is something I was extremely bullish on. So for example, I was one of the first investors who spoke about Aarti Industries as a transition. So I coined a term called Chor Bane More. And my example was Aarti Industries back then, because which was a transformation. So Chor Bane More was a tagline. It did not imply every chore will turn into a more. So now the problem with the chemical sector is everyone now loves chemical and doesn't understand anything about chemicals. So it's like 2011 to 15, everyone said pharma went up 10x. Then everyone said, "Arey, pharma is superb." Nobody knew the full form of ANDA or even the FDA. So today it's a think chemicals will do great. Everything will come from China. The fact is, India is the only country which has kept chemical companies shut in the whole world and is not considering it to be essential. So my point is, chemicals are, some of them will do good, but a lot of them you have no understanding about. So for example, for a 20, because I've looked at chemicals before, a lot of companies used to go through pollution problems. They used to go through delayed, say, expansions. They've gone through fire accidents. So this is the first time we are seeing fire accidents. Like very recently, there has been a fire accident inside Camlin Fine Chemicals plant. So a lot of people do not know the risks involved with the chemical companies. For example, when I invested to Aarti Group, they had a accident in 2012. Atul Limited went through Gujarat Pollution Board problems. So chemicals today are priced for perfection. For example, Atul today, 23% of the holding is with mutual fund. Deepak Nitrite, which nobody wanted to understand UIPs before, now 15 to 18% of the holding is with mutual funds. So my problem with chemicals is a lot of them are very well discovered, very well known, very well participated. And we don't understand, boss, whether it is coming from China to India or not. The not as easy as it seems. So, for example, there's a company called GMM Fodler, which provides glass lining equipments for them. It is quoting at 10x sales. So that is crazy valuations. So the assumption is chemicals will keep expanding, and that company is quoting at 10x sales. So it just doesn't make sense. So my view is chemicals, either you understand the sector or you just avoid the sector. If you don't understand, avoid, because you'll end up getting what happened with pharma. So 2015, the best of pharma, the largest sectoral index weight, today that stock is down 50%. But DVs is up 100% from those prices even after. So you should be able to differentiate from a good pharma and a bad pharma. So DVs has been the best one. Bad one was Sun Pharma is down 50%. Lupin is down. So maybe in the next 1 year, we could be in a place where chemicals is similarly placed. 5-year bull market.
One last question. What would be your advice to new investors who are looking to the market?
So a new investor looking into the market should first start with mutual funds and start with mutual funds and index funds because they do not have the risk appetite, they don't understand. And the problem is any new retail investor ends up in India buying all the shitty companies. So shareholding of Jet Airways keeps increasing. Shareholding of any stock which keeps falling keeps increasing. So what we see is a retail shareholder should go through mutual funds because see some of the companies which we invest in may have not even heard about at times. So for example, they may not know about chemical companies in 2014-15 because chemical is not what they consume, right? So they have heard about it and they may never invest in chemicals. Stock selection for a normal retail investor is difficult of doing either mutual fund investments or find an advisor.
Thank you, Nooresh bhai. I now request Jyoti Ahuja to propose a vote of thanks, please. Jyoti, are you there?
Yes, sir.
Yeah, please.
Am I audible?
Yeah.
Yes. Thank you very much, sir. This topic was totally different than what we attend on a day-to-day basis, but it was very interesting for a novice person also. Thank you very much, sir.
Thank you.
Thank you. Special thanks from my side, Nooresh. I know on a market day you are getting so many calls and still taken time out to give your presentation over here. Thank you once again. And thank you, Vijay, for organizing this nice event along with so many associations.
All right.
Thank you, Nooresh bhai, for accepting our request and coming out on a busy day. Thank you, Asawaji, for conducting the session beautifully. Friends, now here on, as announced earlier, we will be meeting every Saturday at 11:30. And if there are any developments, we will keep you updated. And I thank you all for cooperating. जैसे बोलते हैं कि हम चलते गए, लोग जुड़ते गए और कारवा बढ़ते गया. We started with 2 associations, Tax Friends and Tax Practitioners in Thane. धीरे धीरे सब आते गए और कारवा बढ़ते गया, and we ended up to being 6 associations. And friends, something is coming, so keep tuned. We'll keep you updated.